Welcome to TheoTRADE. This is Don Kaufman. April 3rd, 2024. Just seconds after the cash close here on this Wednesday afternoon. The S&P's finishing listlessly higher. For the most part, today's trade activity is very much forgettable. Listen, right now, you got markets. Well, let's take a look at them. Near all-time highs. But there are definitely signs that the economy is slipping. And there's a huge disconnect between what you're seeing in terms of price action on a day-to-day basis and what we would look at as the real economy. So in this evening's video, we're going to explore a little bit about some of the price action specifically today, a little bit about the implied volatility and kind of what's right in front of us. But we want to look out on the horizon a little bit in this evening's video. Because I cannot help but continue to look at the number and the magnitude of retail stocks that are, for the most part, getting annihilated out there. Let's get started here. First and foremost, taking a look at some of the price action in today's trade. The first thing I want to do is go over to the SPX, the mother of all products. And the reason I'm bringing up the SPX is right across the bottom of your screen, which I'm about to highlight right now. That line right there is the lower. Again, that's the lower SPX expected move. And it's pretty critical because I think it's going to come back into play in the next, 24 to 48 hours. And again, to give you guys a specific number to it, one of the most important things you can do is kind of, take a look and say, all right, the SPX lower expected move is 51.92, and I'm going to tell you exactly why. So 51.92. Now, how does that convert to the S&P futures? And one of the things people get very confused with is S&P futures and SPX, which is a cash product. They do absolutely unequivocally differ. So just be aware that, yes, I'm looking specifically at the SPX and why it matters and why it's going to come into play. As I said, it's the lower edge of the expected move. And it's not like a mythical, magical beast of a number, like a Fibonacci that's a 618. This is where hedging activity is likely to draw the market back to. And we have a number of catalysts right ahead of us, both, of course, on Thursday, which, again, you can argue that Thursday is not, anything compared to Friday, because Friday morning, what do we have on Friday morning? None other than the employment situation. Look, neither here nor there. Push it aside. It's just a match that's being thrown into a pool of gasoline. And I wanted to start with this because, the employment situation's coming out. And as I said, what matters right in front of us? Well, some implied volatility. And there is some implied volatility. We're still looking between now and the end of the week at about 43 some odd dollars of movement, in terms of what is expected. And as I said to you, it's kind of a high probability to get drawn because of hedging activity. Will get drawn right back into this 51.92. And again, that's 51.92 in the SPX because that area, you kind of think of it as, it's almost like the happy place, of hedging. It wouldn't surprise me that when the jobs number comes out on Friday morning, wouldn't surprise me if we were sitting right on the 51.92 prior to that. And then we get this explosive move, either higher and or lower. One of the things that also, I'm kind of mindful of. Now, there's no specific probability for this, but one of the things I'm really mindful of, we've only had this year one breach to the downside of expected move. However, this week, no question, we're kind of dancing. You can see right on that lower edge of the expected move. So, look, from a probability point of view, in any given week, it doesn't matter, look, in any given week, probability point of view, expected move is standard deviation. So for the most part, you would say, hey, look, there's a 68% chance we're going to be inside this range. So you always go with the higher probability that we're going to fall inside of the range. But again, we're kind of riding this lower edge of the expected move. Keep it in mind as the week kind of progresses, because coming into Friday morning, if we're riding that lower edge of the expected move, you got to recognize that jobs report can rock that marketplace outside the lower edge of expected move. Things could get crazy in quite a hurry. Look, we're still seeing what I would kind of term a bit of a slop fest of a marketplace. I mean, today, trade activity, there really wasn't much, okay, to speak of. And again, we could probably talk about, well, the Fed said this and the Fed said that, and there was an ISM number that took us up, and then the Fed took us back down, but we overreacted. Okay, look, it's all for nothing. Price action, where did we end up today? For the most part, massively unchanged. But there are some interesting moves in the screen. You look at like Intel today, that thing has just been getting annihilated as of late. So not exactly great news over here, but I said it's a great day for me to explain in more detail what I see is this fairly dramatic disconnect between, I guess, what everybody would call like Main Street, and Wall Street. And that is, we're starting to see a lot of retail stocks. And it's something that I look at, right? I look at retail stocks a considerable amount to kind of get a feel for what's going on in, Main Street, what's going on out there. And I found, it's not just like, one retail stock or two retail stocks, and they're spread, okay, over a very large array. And I'm actually going to show you, well, right now. So I'm going to switch over here from my list, and I'm actually going to cruise over to, a list, and it's kind of cool because you can always build, more and more lists in here. But this was called, I put retail is slipping. So to get a quick feel for this, yet another major retail today came out, and you want to talk about slipping is Ulta. Now you look at this and you think, again, it's only one underlying. Yeah, we said that, originally when we were looking at something like Lululemon, which has been getting absolutely decimated. But okay, you could probably say, well, it's similar, right? It's makeup, okay, cosmetics, great. Lululemon's higher end athletic wear, but then a subsector of that would be like, if you look at Nike, okay, and it's worth looking at these on a year-to-date basis because like Nike's down 15% year-to-date basis. Lululemon's down almost 26% year-to-date basis. Ulta, okay, Ulta is getting hammered specifically today. It's only down about 9.5% year-to-date basis, and then we can kind of spread from there. So again, I think you can make arguments. All right, Nike, Lulu, kind of similar. Maybe Ulta. But then you start going into discount retailers like Five Below. And again, you can make all these arguments like it's mismanagement, it's this. Look, the sheer number over here, by the way, Five Below is down about 23% year-to-date basis. The sheer number of underlyings in retail, okay, across a wide, okay, portion of the sector in different compartments, meaning that some of these are higher end retail, some of them like Five is lower end retails. Nike's probably, you construe in between. Then we're going to look at discount, which is, mainstream retailers like Costco. But here's another one that just got annihilated yesterday. Okay, and this is PVH, which everybody, you may not think but everybody knows PVH, Tommy Hilfiger and so forth, but also took down Ralph Lauren. So this was actually up 15% 2 days ago, and it's actually down now 13%. We start looking at like Ralph Lauren. Ralph Lauren actually got taken down by that. Still up 18%, but I have it on the list over here because now I'm starting to pay careful attention. Here's a fun one. Victoria's Secret, fun for the whole family. It's down about 35%. Again, I just wanted to show it's all right here, right now. Yeah, some of them have been more gradual slips. Like, I think you can make the argument Nike was kind of gradual and then got absolutely crushed in the most recent earnings. And you can look at Lululemon, and Lululemon was doing all right, until it got crushed in the most recent earnings. Okay, and Ulta, it just got crushed in the recent earnings, bounced back up and got absolutely killed. They basically said today that the slowdown is accelerating. Okay, now Five Below, again, here's one where you want to make every argument and they got crushed in the most recent earnings. Are you seeing the pattern in here? Okay, it's not good. It is not good at all. Like, again, you're a trader, you need to look and like, hey, when are the earnings coming out? Let's go look at something that, you're going to think is impervious to anything, and that's going to be Costco. Costco got crushed in the most recent earnings, continues still to slip. First of all, I would say that any major retailer coming out with earnings right now, doesn't matter what you think, it might actually be worthwhile. Just take some, 1-for-1 bets on bearish positions. Everything coming out right now looks like it's getting hammered. So we cruised down the list, and again, I was looking Victoria's Secret, but then I started to differentiate. And I started to go to stuff that's like, oh, home improvement, like restoration hardware. That's, of course, it would be construed as, you're like, that's not home improvement, it's furniture. Yeah, it still goes into the same ETFs that are like home improvement. But in any regard, look at the most recent 3 trading sessions over here. It was up 22%. Now it's basically hanging on by a thread to almost unchanged on the year. Home Depot, okay, huge move in the last couple of days. There is something clearly going on. Start to pay attention. Lowe's, obviously moving in sympathy with like with a Home Depot. Look, okay, it's too early to start to panic over here, but retail, it's in trouble, and it's beyond retail. It also looks like, again, as I said, like a little bit of home improvement. I've already started looking over at like XHB, and XHB, it's negligible. This actually could be a huge opportunity. I started looking at some of the retail ETFs, okay, which are like XRT. Now, some of these products like XRT, okay, they're already starting to take a hit. This could be a lot more dramatic. We're going to look for a ton of different opportunities in the days to come. Look like XLP, okay? This is actually retail sector. These are huge moves. And we're not seeing this. And again, the point of me going through this is we're not seeing any carnage hit the markets. Why? Hey, everything's okay as long as there's advertising. Everything's okay as long as everybody's advertising on Meta, because that's Meta's entire business. Who are those advertisers? The retailers. Start to think about it, because all of the advertising, okay, is done by retail. All right, this company doesn't exist for anything, but for the most part, there you go, almost 95% is core, of Facebook is advertising. Keep it in mind in the days to come. Things are going to get a little bit crazier. Again, market might be at all-time high, but with retail slipping like this, the economy slipping like this, have some concern. Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful evening. Bye-bye.